The trigger in many ways for the inflection in global liquidity was the British gilt crisis, which was almost exactly a year ago, right now. And the British gilt crisis was caused by an errant budget statement by the incoming new British Prime Minister Liz Truss, who spooked the financial markets by basically saying they were going to spend money an unfunded fiscal program that caused the British gilt market, the sovereign debt market, to sell off aggressively. And that spooked a lot of governments worldwide, not just the British. And what they realized was that there's a real risk here of losing control of their sovereign debt markets. British gilt yields spiked upwards, yields rose significantly. But had that same event occurred in the US Treasury market, you'd have had another global financial crisis, rather like 2008.
Welcome back to Soar Financially, everybody. Thank you so much for joining us here on this channel. My name is Kai Hoffman. I'm the @JRMining guy on Twitter and the CEO of the Soar Financial Group. Again, thank you so much for joining us. We're going to have a really interesting discussion, one that I'm looking forward as well, because I'm expecting to learn a lot personally. Where Michael Howell will be joining us. He's the managing director of CrossBorder Capital, and we're going to take a look at liquidity. A topic we have really discussed, like in particular, we've touched on it in various discussions, but we haven't focused on it. And I find that really, really interesting because overall, in the grand scheme of things, if you really, really zoom out on a global scale, liquidity is hugely important. It's directly, intertwined with geopolitics as well, and the balance of power in the world, to be quite honest. So let's dive into that, because I think it's going to be hugely insightful. Before I switch over to my guest, just a quick reminder, 80 to 85% of you are not subscribed. There's a box right there. It says subscribe on it. Please hit that. We really appreciate it because it helps us bring guests like Michael onto the program and to have fantastic discussions. Now, Michael, thank you so much for joining us here on Soar Financially. Thanks so much for your time.
Great pleasure, Kai.
Absolutely. Yeah, it's great. I'm looking forward to this discussion because diving deeper into the world of liquidity, I think is a topic that's not really well understood overall. Personally, that's just based on my perception and what I'm reading and sort of the media and news I'm picking up. So I'm curious to learn a lot more. Let's start maybe with that and explain the global liquidity flows a little bit and what you're doing exactly.
Okay, well, I think you're correct to say that it's not very well understood. It's a complex area, which probably makes it difficult to track and to understand. But it's probably the most important thing for investors really to understand, because money drives markets, and what we need to understand is which money is the important thing for driving certain markets. Money has different forms. There's a hierarchy of money, and what we're doing is we're basically tracking a concept that we call global liquidity. Now, global liquidity is a flow of money. It represents about $170 trillion, so it's a vast pool of liquidity or cash. It's something like 1.75 times bigger than the size of world GDP, so it's a big number, and it's driving essentially financial asset markets primarily, and then it's spilling over to drive real economies subsequently. It was a concept that we basically devised, more years ago than I remember, basically when I worked for the US investment bank Salomon Brothers. Salomon Brothers, as probably many people may recall, was the world's biggest fixed income trading house. It was the fixed income markets in many cases. It was key in the US Treasury market, JGB market, etc. It was very big in foreign exchange. And how Salomon Brothers essentially made its money or made profits out of its proprietary trading was to understand money flows and the flow of capital around the world. And that gave tremendous insight into how markets will move. You were effectively following the money flows. And that's what we're principally doing now. We're trying to understand those money flows. We're tracking those money flows. We monitor now over 90 financial systems worldwide. We do that intensively on a monthly basis, and in many cases for the bigger economies, we're looking at that on a weekly basis. So we've got very great insight into international liquidity flows, global capital flows, etc., and that really colors our view of markets.
What are some of the indicators you're looking at on a regular basis? Just help me understand, like, how do you actually track it? Like, what are you looking at? M2, M1, M2, I think people are somewhat familiar with because it's the amount of money, right? Yeah. But what other indicators are there?
I think what you've got to do is, first of all, to understand how money relates to the economic system. And the way that we do that is really dividing money into two very separate pools. One is money that's in financial markets or asset markets more generally, and the other is the pool of money that's driving the real economy. Now, what you tend to find is that you've got a sequential flow, if you like, of money that moves from the asset economy into the real economy. And that asset market flow is primarily started by central banks. So central banks can't, or very rarely, have the ability to direct money directly into real economies. They have to do it, first of all, by stimulating financial markets, if you like, lifting asset prices, and then ultimately that money flow will spill out into real economies. So if you look at a sort of a pipeline of money flow, it begins with the central banks. It's levered up by the banking systems in the financial markets. Asset prices tend to go up, and then money will move into the real economies. Now, you came up with a concept called M1 or M2, which are very familiar measures of the monetary aggregates. They're not the things that we look at. M1 and M2 are sort of archaic concepts that were probably relevant decades ago, but they're not really relevant now. And let me explain why. The first thing is that those measures, M1 and M2, are defined rather arcanely as the retail deposits of high street banks. Effectively, that's what they that's what they make up. And those two concepts, retail deposits of banks, are not the main funding vehicles of high street banks. High street banks in themselves are getting funding directly from money markets or from capital markets, and the deposit funding, which used to be the principal form of funding, in other words, retail deposits, what you and I will actually deposit into a bank, have been eclipsed in many cases by capital market funding. So number one is that those measures don't give you any insight as to what the lending behavior of banks would be. The second thing is that banks are no longer the most important elements in the financial markets. There's a concept called shadow banks. Shadow banks are basically other financial institutions that can provide credit within the system. And that may be hedge funds, it may be pension funds, it may be other forms of banking. It could be mortgage banks like the GSEs in the US. It could be people trying to provide credit through securitization. There's a whole raft of other forms of credit creation that in many cases get quite wonkish and very complex, but they've really eclipsed the traditional banking systems. And it's that pool of money which we're largely monitoring. And that money tends to be very fast moving, much bigger than traditional measures of M1 and M2. And that's what's really driving the asset markets worldwide. And ultimately, as I said, driving the real economies, because that cash will spill over into real economies ultimately.
Interesting. Yeah, I really appreciate you explaining that. Huge learning curve, or a very steep learning curve for me here as well. So I find that interesting because I noted down shadow banks as well. Like, what do you mean by the term? Because I found it on your website. So I appreciate you explaining that, trying to understand that better, right? So let's look at the results of your studies as well. Like, where is the money flowing right now? Like, what markets are, let's, for lack of a better term, what markets are hot right now?
Okay, well, let's step back and say, how we analyze and how we frame
Okay.
this. And what we think about is a global liquidity cycle. In other words, you see peaks and you see troughs, and you see a cyclical movement in the flow of liquidity. And let me stress, this is liquidity that is in the financial markets. Now, one of the great paradoxes of monitoring liquidity is that what you tend to find is that all money that is anywhere must be somewhere. So if it's in the real economy, it doesn't necessarily mean that it's also in financial markets, because you can only really spend $1 once. And if that money is in the real economy, it's basically driving real economic activity, and it isn't necessarily boosting asset prices. On the other hand, if it's in the asset markets and inflating asset prices, it therefore isn't necessarily in the real economies. So what you find is there's a paradox that it's very often the case that strong economies have weak financial markets or weak asset markets, and weak economies actually have strong financial markets or strong asset markets. And that's one of the paradoxes that is currently unfolding. So people can't quite understand why, if economic activity worldwide is basically slowing down, which it is at the moment, why is it that asset markets, particularly the S&P 500, is basically rising to new highs? This is really a great paradox. And the answer is that basically that money is not in the real economies. It's moving out of the real economies into the asset markets. So let's try and frame this idea of a liquidity cycle. The liquidity cycle, as far as we track it, essentially has a length of about 5 to 6 years. That puts it somewhere close to a sort of political or presidential cycle. It's something of that sort of ilk thing to remember. Where are we in that cycle? We've basically passed the trough. The trough of the cycle was around about September of last year. That was when monetary tightness in financial markets was at its most extreme. And since that point, what you've seen is monetary conditions, in other words, liquidity, global liquidity, begin to pick up. Now, I'll get into the weeds and detail of that in a second. But then you've got to ask the question is, how does the real economy relate to that cycle? And what you find is the real economies worldwide tend to follow the liquidity cycle by something like an average of 15 months. Now, sometimes it's a tad shorter, sometimes it's a little longer, but you can get a range of maybe 12 to 20 months around that 15-month average. So you're looking at, let's say, just over a year or so for that lead time. So if the global liquidity cycle troughed in September of 2022, what we should be anticipating is some sort of inflection in the world economy, the trough of the world economy, sometime around third quarter, end of third quarter, fourth quarter of this year, maybe as late as the turn of 2024. But in other words, it's upcoming. And a lot of economists are continuing to predict whether we go into recession or not, without really understanding that a lot of the slowdown has already occurred. And we should be thinking much more about when the next upturn is likely to occur, rather than when we're going to register negative rates of GDP growth, which may not ever happen in reality. Now, if you then come back to the point of why is that liquidity cycle turning, and what are some of the characteristics that we should see around the trough? Now, needless to say, when liquidity conditions are tight, financial markets suffer. And what you tend to find are two very distinct characteristics of financial markets around that time. One of those is that what is called the yield curve, which is looking at the term structure of interest rates. In other words, we're looking at the spread between, let's say, a 10-year bond and a 2-year bond. What you'd normally find is a measure of tightness in financial markets will be that curve inverts. So the yield at the front end of the interest rate structure, in other words, the 1 year, the 2 year, or even the 3-month rate, sits above the average of the 10-year bond. And that is what's called an inverted yield curve. It's abnormal because the yield curve is normally upward sloping. It has a positive gradient. So this is saying the gradient on the term structure is negative. So short-term rates sit above long-term rates. That is a characteristic of a trough of liquidity. And lo and behold, we've got that. I mean, that's one of the evolving characteristics. That term structure or yield curve should be soon beginning to retain or to regain, I should say, a positive slope. So that's point number one, confirmation of where we are. The second thing is you normally get banking troubles. What have we had around that point? We've had a number of instances. The trigger in many ways for the inflection in global liquidity was the British gilt crisis, which was almost exactly a year ago, right now. And the British gilt crisis was caused by an errant budget statement by the incoming new British Prime Minister, Liz Truss, who spooked the financial markets by basically saying they were going to spend money, an unfunded fiscal program that caused the British gilt market, the sovereign debt market, to sell off aggressively. And that spooked a lot of governments worldwide, not just the British. And what they realized was that there's a real risk here of losing control of their sovereign debt markets. British gilt yields spiked upwards, yields rose significantly. But had that same event occurred in the US Treasury market, you'd have had another global financial crisis, rather like 2008. It would have been of that ilk. That was the magnitude. but so happened it occurred in, if you like, a sidewater British sovereign debt, not in the US Treasury market, which is the most important financial market worldwide. Now, from that point, we've seen central banks begin to inch liquidity back into markets. That was spurred by a subsequent development, which was the failure of SVB, Silicon Valley Bank, and CSSB, the Swiss US banking group, around February, March of this year. That caused the Federal Reserve to push more liquidity into markets. And what you're seeing essentially worldwide is an inflection starting in global liquidity. Now, there are other factors which come into that. You've had a lot of the emerging market central banks beginning to ease policy. They've effectively been ahead of the curve in many cases. You've had the Bank of Japan pushing money in. You've had the People's Bank of China trying when it can to sort of goose their economy by pushing more liquidity in. So generally, central banks are moving back towards an easing phase. Now, their rhetoric is not that, okay? Their rhetoric is still, we're in tightening, we may be hiking interest rates. Well, of course, they would say that, wouldn't they? But actually, beneath the surface, they're beginning to add liquidity, and you're seeing the early signs of a liquidity expansion and an easing of policy. Now, what are the signs of that in markets? Well, let me just say that there are two very immediate signs of that process. The most liquidity sensitive asset classes worldwide, if you like, are long duration stocks like technology stocks. In other words, they're very sensitive to changes in liquidity. And the other thing is cryptocurrencies and to some extent precious metals. And what you've seen is a pickup in all those asset classes. And that's pretty much a confirmation that liquidity conditions are starting to improve again. So in terms of confirming signs and where we're in the cycle, we think we're in the early stages of a rebound in global liquidity conditions. Now, in terms of analyzing the cycle, what does that mean? We split the cycle into four very distinct investment regimes, okay? And those regimes are called rebound, which is the stage we're in now, calm, which reassuringly means it is quite calm for investment, speculation, which is a more frothy stage, and turbulence, which is the stage you want to avoid, okay? The global liquidity cycle moves in 5 to 6 year sweeps. We're moving into rebound now. The unattractive turbulence phase is unlikely to be with us until 2026. So reassuringly, investors have basically got the wind behind them now rather than the wind in their face. And 2020, late 21 through 2022 was the period of turbulence in the last cycle. So we're through that, thankfully. A few markets are trailing in that area, but we're moving up quite quickly. And the majority of markets are now moving into this rebound phase. Now, what should you see in rebound? You should see a number of characteristics that we think confirm where we are. One of those is that equity markets and credit markets should outperform government bond markets and commodity markets, okay? And that principally is what's going on. Within industry groups, within, let's say, the S&P or within global stock markets, you should see technology outperforming, cyclicals generally outperforming, and defensive stocks underperforming, okay? And those are the characteristics of the phase that we're in right now. The US market tends to be a leader in this phase. If we move to the next phase, which is, let me stress, we're not there yet, but the next phase is calm. In the calm phase, you should be looking to buy commodity markets, switching your industry group exposure slightly away from technology. Technology will still perform, but you want to be putting more into energy and more into financial stocks, keeping underweight in defensive names, not moving into government debt yet, and probably taking some profits in credit exposure. So that's what the next phase should be. Generally, we think that the market cycle is being propelled by what we describe as a monetary inflation. Now, I'll get into some more detail about that right now, but save that to say that what we're really talking about is central banks basically monetizing debt. Now, why is that something that everyone needs to think about. It's because if you look at what's happening globally, or if you look in microcosm at the US, you're seeing a massive fiscal expansion right now going on. And this is a legacy, if you like, of the COVID years. Now, COVID in many cases was a watershed, not just in the medical sense, but actually in the economic sense. And it was a watershed simply because governments decided they were going to spend more money, but they were not going to tax people. So in actual fact, that whole raft of additional spending was basically funded by financial markets through debt issuance or money printing. In fact, at the end of the day, it came through money printing because by some quirk, the central banks bought a lot of the debt that the governments issued. So effectively, it was a pure monetization. They printed money to essentially bail us out of the COVID crisis. Now, it seems to me that that is the path of least resistance going forward. If you've got massive fiscal spending, and let's just think about why fiscal spending is increasing. And if you take the US as a very good example, and in fact, the US is maybe in many cases, as we say, is the cleanest shirt in the laundry here. A lot of other countries are in far, far worse fiscal shape than America. But America faces a number of challenges. One is that aging populations means that mandatory spending on things like Medicare, Social Security are escalating fast. You've got Biden's program of infrastructure spend and the green economy, which is coming on top of that, which is a huge spending program that many people have actually identified as being the biggest spending program since World War II. Well, put that into perspective, has to be paid for in some way, doesn't it? And then you've got on top of that, defense spending. Now, if you look at what the Congressional Budget Office, which is an independent arbiter of US fiscal plans, is saying, the Congressional Budget Office is saying that the fiscal debt load is going to get more and more weighty. So within, let me say 25, probably 30 years, or it's actually 25 years, what you'll find is the debt to GDP ratio of the US goes to 200%. It's over 100% right now, okay? So you're looking at a massive debt burden, and their numbers, the Congressional Budget Office numbers, probably are way too conservative. I mean, they're putting even lower, they put low numbers on defense spending. We think that if you jack those up to more reasonable levels, what you're finding is, the demands on the fiscal purse are just, are eye-wateringly large. Now, the question is, who's going to pay for that debt? Who's going to pay for these programs? Who is going to buy the debt that America has to issue? Now, what you've had in the past are two big buyers, okay? You've had the Federal Reserve, which has come in through its quantitative easing programs and bought up a lot of the new debt issuance. The second thing is you've had foreign governments such as Japan, China, Saudi Arabia, basically buying a lot of American debt. So much so that about a third of outstanding debt was owned by foreigners. Now, that is no longer likely to be a luxury that America can look to, for the simple reason that we can't believe, or few people could probably believe, that the Chinese are going to be as big a buyers of US treasuries in the future, given the geopolitical standoff that we're getting, that they were in the past. The Japanese may well continue to buy, but they've got their own challenges. And if the yen is very weak, which it clearly is right now, their ability to keep buying treasuries is actually compromised. And then you've got the Saudis. We know that the relationship between MBS, the Saudi Crown Prince, and Biden is very, very bad. He shuns any American, requests for lower oil prices or more oil supply. So it would seem that he's playing a difficult game or a tricky game. And are the Saudis going to be big buyers of US treasuries in the future? Seems like they want to put all their money into European soccer stars and spend money that way on a sports franchise. But if money is going to Ronaldo or whoever, it's not going into US treasuries. And this is really the key thing to try and understand. So you've got that dimension. And the Federal Reserve recently has been doing so-called quantitative tightening. So they've been actually letting bonds roll off their balance sheet and go into the private sector. So there are clearly challenges that the US has got to face. And in our view, that circle is squared by the Federal Reserve coming back and actually buying debt and in re-engaging in a QE program. Now, what I can absolutely 100% guarantee is that that program will not be called QE. It'll be called something else, because cosmetics are important here. And the reality is that debt has to be monetized. Now, that is called a monetary inflation. And history shows that by far and away the best hedge for monetary inflation, and I stress a difference here between high street inflation and monetary inflation, and I'll clarify in a second. But for monetary inflations, the best hedges are real assets, but particularly precious metals and increasingly cryptocurrencies. And that's what we've all got to think about. Now, what's the difference between monetary inflation and high street inflation? High street inflation is what you pay in the shops, but it comprises of two parts. One is a monetary element, monetary inflation, if the central bank devalues its paper currency. And the other is a cost inflation element that comes through because of, by definition, changes in costs. And that could be because you're outsourcing to cheaper suppliers in China. Oil prices go up. That's a source of monetary inflation. Cheaper Chinese goods are a source of monetary deflation. Labor costs go up. That's a cause of cost inflation, etc. So what you've got to differentiate are those two elements. Many people say gold is an inflation hedge. Wrong. Gold is a monetary inflation hedge. Gold is not a high street inflation hedge, because what you've got to look at is the differential, which is the cost element. Gold is a great monetary hedge, not a high street inflation hedge. If we've got monetary inflation, then buy gold, buy crypto. But what we also know is commodity markets move with a small lag to the gold price. So if you've got strong gold prices, you're going to generally get commodity markets going up. Now, to come back to my asset allocation thought, if we're moving in the cycle sequentially, and we're moving into a phase now where you're moving from rebound, and I hesitate to say we're not there yet, it's still in the rebound phase, but moving into a phase of calm where there's more liquidity, you've got to start building up commodity exposure.
Michael, that was hugely insightful. I didn't dare stopping you there. I learned a lot. Hugely insightful. Like, the question is, how do I follow up on this now? I made some notes, obviously, while you were chatting, and one big one for me is sovereign debt, or the role of sovereign debt. Because you mentioned, China might be disappearing as a buyer, but my understanding is they're actually a net seller of U.S. Treasuries and U.S. liquidity, for a lack of a better term. Is that a fact? Is that something we're witnessing?
Well, the answer is that the Chinese are their stock of treasuries is going down. Okay, in the latest data. Okay, now that is probably a short-term quirk of the data. In the longer term, the Chinese will probably have to buy more. Okay, and I'll come on to why in a second.
I was going to say, you need to elaborate on that, please.
Yeah, but they're not going to be buying in the same scale as they were buying before. Now, why do they have to buy? The reason being is that China has a trade surplus. And the answer is, where can it put its surplus? Which asset markets are available to it? Now, it could buy Saudi oil. And actually, interestingly enough, that's one of the things it's been buying. It's been building up its strategic petroleum reserve over recent weeks and months. That's clearly one sink for the money. But at the end of the day, a lot of these other real commodity markets or financial markets are simply too small to accommodate the size of the surpluses that China's running. And so they ultimately have to think about putting it into financial assets. And by default, if a lot of their revenues are actually coming in dollars anyway, they're going to have to somehow leave them in dollars. Now, I fully understand the fact that the margin, they may not be doing so much. Okay, this is the point. So at the margin, they're not going to be buying so many dollars. They are going to be putting money into other schemes. It may be they are putting money into building up oil reserves or buying strategic commodity positions or putting money to work in a Belt and Road Initiative program through infrastructure. All these things are quite feasible, okay? But ultimately, they've still got this question that China is a sort of quasi-dollarized economy. and it's very, very difficult for them to get off the dollar hook, which is probably a neat segue into talking about, will the Chinese yuan ever come to dominate the dollar? And the answer from what I've just said is not. Now, I'll say a little bit about the dollar and the role of the dollar, which is probably a good opening to do that. There's a whole lot of talk about will the dollar be eclipsed? Okay. The short answer is not in the medium term. It's possible in the long term, but the long term is a long, long way away. And let me try and sort of articulate that by saying, what's the current architecture of the international monetary system? And although many people have thrown ideas around, like you may have heard of these Bretton Woods 2, Bretton Woods 3, all these sort of ideas. It's fanciful stuff. We're still in Bretton Woods 1 in reality. And what was Bretton Woods 1? It wasn't just a fixed exchange rate system. That was actually, if you like, I'm not going to say an afterthought, but it was an adjunct of the main structure. What the Bretton Woods system was a monetary system that had the US dollar as its center. It had the World Bank and the IMF, if you like, as sort of policemen that were policing current account imbalances and making sure countries could basically pay their way. And the whole system was backstopped by the US military. And it so happened that you had, when the system started, fixed exchange rates and capital controls. Now, as soon as the capital controls came off through the 1960s, it became impossible to hold on to the fixed exchange rate idea. So currencies were floated. And as it happens, one of the great paradoxes of that floating was the dollar became even more dominant within the system. So, that's a thought to hold. But basically, we're still very much in that Bretton Woods 1 structure, because you've got all those sort of pillars that I described, apart from the fixed exchange rate point, which I didn't think was critical to the structure anyway. We've still got the dollar as the centerpiece. Now, what is it that makes that structure so important? It's simply because although trade is denominated principally in dollars, the US acts as banker to the world. Now, what does that really mean in practice? It means that if the world wants to borrow, it can borrow in dollars from US banks, okay? If the world wants to save, it can save in US financial instruments. And the US is flexible enough to basically, act like an accordion, or whatever you might say, and to expand and contract accordingly to accommodate the needs of the world, okay? Now, it comes back to the point of, why is it, therefore, that the US runs this massive current account deficit, okay? And many economists say, oh, well, that tells you that the US is a very uncompetitive economy. The economy is low productivity, or whatever, it's being eclipsed, competitiveness being lost, etc. You've heard the arguments. Actually, that's complete rubbish. It's simply the fact that it's not the US industry that's uncompetitive, it's the US financial system that is super competitive. And by definition, balance of payments have to balance. So if you've got a big surplus on your capital account, your current account, which is the trade balance, principally, has to be in deficit. So this is just a corollary of the fact that US finance is so super efficient. And that's the world we live in. Now, the question to ask is, could China play that same role? Could China act as banker to the world? Well, number one, its financial markets are not deep enough. I mean, what can anyone buy in China? I mean, they could probably buy the government bond market, but would they really want to do that? If the Saudis want to put all their oil revenues into Chinese government bonds, good luck there. But I don't think that's a particularly sensible long-term investment. The Chinese stock market's, too shallow. You wouldn't want to invest in Chinese real estate, I'm sure, in all honesty. So that's out. And therefore, you go to the other side. Could the Chinese banks be lenders of, lenders to the world? I think that's unlikely. In many cases, I mean, there'll be too much of a political decision being made anyway by those state banks in terms of giving credit or not giving credit to different entities. So the whole idea that the Chinese yuan could eclipse the US dollar is fanciful. But having said that, let's make no mistake that the intention of the Chinese and the intention of maybe the BRIC countries is to chip away at US influence and to make it difficult for the US to remain the sort of the dominant currency worldwide.
Really, really interesting remarks. Like, we need to have a follow-up discussion on that. There's so much to discuss here. Bringing geopolitics into this discussion here as well, because we could talk probably 30 minutes also about the BRICS and how that sort of construct actually works and affects the global liquidity markets. When you were mentioning, well, where can China put its money? My brain went to Brazil, right, and supporting the markets, and I think we're seeing that to a small degree. But as you said, it's a matter of size,
Yeah,
right? And
exactly. I mean, the thing is that China is so dominant in the BRICS universe that the money it would put into Brazil would sort of represent its lunch bill. I mean, it's not meaningful for
yeah,
China. So it needs to get rid of that surplus, and the dollar markets are really the only place at the moment.
super interesting. Yeah, and it's a very different discussion. Like, it gives me a lot of food for thought because I haven't had that discussion on this channel before in that context. It's a very different perspective to look at things. We always look at geopolitics and how China might bring in a gold-backed currency together with the other BRICS, but it's a discussion from the other side of the table. Like, we're always looking from the US to the other side, but now we're actually looking from, okay, where can China actually put its money realistically? Really
Yeah,
interesting because we haven't had that discussion.
I think you can. I mean, I think you can sort of create a narrative that's quite interesting by sort of looking at what's happening in the BRIC economies. And for example, one of the things that you can track, which we put a note out to our clients a couple of months ago, which said if you look at the gold reserves of the BRICS economies and their friends who are seeking to join the BRICS club, actually, as of September or October of this year, they will just eclipse, or in other words, exceed US gold reserve holdings. And that's come from virtually nowhere in a decade. There's been this tremendous buildup of gold reserves, not just by the BRICS themselves, by some of these associated economies. So now the stock of gold under the command of this BRICS plus extended framework now exceeds what's in Fort Knox. That's a thought to hold. And where that would tend to impact is much more on the treasury market, in my view, the US treasury market, yields on the treasury market, than on the dollar itself. Now, there's clearly a linkage, but you'll see the effects much, much more in the treasury market. So what that really comes back to is the question of how easy it is or how difficult it is for the US to actually fund itself, and more particularly, which is an ongoing issue, how can it refinance itself? Now, one of the issues with the bond markets, which one tends to forget if you're buying equities, is that bonds need to be rolled over. Okay, so if you've got a bond, a 5-year bond, you're going to have to renew that bond in 5 years. And if you look at the stock of debt worldwide, the stock of debt is about $350 trillion. Okay, now the average maturity of that debt is about 5 years, which means that you've got to refinance on average about 70 trillion of debt each year, aside from what you've got to do in primary issuance for funding new deficits. You've got the existing stock you've got to roll over. So you've got 70 to fund, just for starters. To do that, you need balance sheet, and that is financial capacity. So that is by definition liquidity. And that's one way to think of liquidity. So debt and liquidity go together. And if you think that we're in a regime where the debt burden is spiraling upwards, which is what most commentators would argue, you're going to have a background of increasing liquidity, because if you don't have that liquidity, you're going to get refinancing crises. And I would say look backwards in history, recent history, in the last 20 years, all the financial crises you can think of have been refinancing crises. It's been difficulty in rolling over debt. Okay. You saw that in 2008. You saw that in 2019. You saw that in the Asian crisis. All these things are about debt refinancing. And what's called for is a lender of last resort to come in quickly and start pumping back money. And that's the role of the Federal Reserve. So if you start to get problems in the debt markets, what you'll get is the central banks come in. Evidence, Britain, September of 2022, they were undertaking a QT policy. Within seconds, they'd reversed that back into a QE policy. They were pushing money back into markets. So that's what we've got to expect. So if we're in a world where you're needing more debt rollovers, more debt refinancing, more debt primary issuance, you're going to have more liquidity, more monetary inflation, as we say, and commodity markets are going to increasingly outperform.
Interesting. Like, good thing you mentioned the treasury market there as well, because one of the questions I have to ask you, Michael, and you're the perfect person to ask, is like, since we raised the debt ceiling in the U.S., over $2 trillion have been issued in additional debt, meaning and maybe the question is like, I didn't see any ripples in the financial systems or in the financial markets anywhere. It seems like the market has just absorbed it. So there seems to be enough liquidity out there, which didn't trigger anything, to be quite honest. And even trying to find some more information on that is difficult, because if you type in U.S. bond issuance or anything, you don't find a lot of like proper news articles on that topic, I find.
Yeah,
right. So
that's a fair point.
So the question, my question is like, how much did the recent bond issuance and the current ongoing bond issuance and treasury bill issuance affect the liquidity markets? Like, do you see an effect from that? So
yeah,
I know it's probably a big question, but I'm looking for like the ripples in the system and maybe the first cracks in a system as well there.
Yeah, okay. You ask a particularly relevant question, Kai. So let me try and answer that. You're absolutely correct. There's been a lot of debt issuance, but we've got to start thinking about the maturity profile of that debt. And what you've got, think of it in very simple terms as two types of debt. You've got bills, which are very short-term paper, maybe lasting on average 90 or 180 days. So they're basically 3-month or 6-month treasury bills. Okay. And you've got on top of that coupon issuance, which is basically longer-term debt. Okay. Now, the bill issuance is highly liquid instruments, and there's a tremendous appetite for that, throughout the financial system. Okay, so it's quite easy to sell that stuff. The problem is you're selling that at a high interest rate, because bear in mind where short-term interest rates are. If you'd have issued coupon debt instead, you'd have been able to get away with a much lower interest charge. But the Treasury is basically funding at high interest rates. What's more, they've got to roll that debt in 90 days or 180 days. So they've got to keep rolling it unless they convert it into coupon debt, right? Now, the bulk of the debt that you've just spoken about, the 2 trillion of debt, which is, this is an annualized amount, but in terms of this debt issuance, the bulk of it is being issued in treasury bill form. Now, I forget the exact percentage, but let's say it's about 80%. It's normally 20% bills, 80% coupons, and now it's been flipped around. So they've done that because that will actually cause minimum indigestion in the financial markets. So your observation is absolutely spot on. That's why you haven't had a lot of disruption. Now, one of the ways that they've managed to fund that is, this is a particularly wonkish concept, but let me just try this out. On the Federal Reserve balance sheet, there is if you like, a reserve pool of money. It's not really called that, but it basically is what's called the reverse repo program. And that money is money that is held on the Federal Reserve balance sheet, but is not circulating. And it's basically, or largely, invested in by money market funds. So money market funds, let me step back. In the wake of the COVID crisis, money market funds saw huge inflows because deposit growth in the US, because of all the tax handouts, were huge. And so people had excess savings. Did they put it into banks, which were paying low interest rates, or did they put it into money funds, which were paying much higher interest rates? So a lot of that money went into money market funds. Now, when the COVID crisis was ongoing, the Treasury was funding that to a large extent through bills, so the money market funds could put their money into Treasury bills, and they were quite happy. But then after the COVID crisis, the Treasury switched from bill financing to bond financing or note financing, coupon financing, and therefore the money market funds are at a loss as to where to put these excess deposits. So the Federal Reserve created this tranche on the Federal Reserve balance sheet that was called the reverse repo program. And that reverse repo program basically took money from the money market funds and it held it, if you like, out of circulation. What's happening now with the bill issuance that we've got ongoing is that that money, that pool of money that's, if you like, off balance sheet or out of circulation, is now being pulled back into the financial system. So the Treasury has got a win-win situation. Okay, but it's a window because that program is finite. But the program has come down. The reverse repo tranche has come down by, it must be close to $1 trillion so far in the last few weeks. So, this is a big, big drain. But it's had limited effect on liquidity for the reason that I've said. It's money that was off or out of circulation that's really been put back into circulation. But that's finite. So the next stage is they've got to start issuing coupons, and that's where the strain is coming. And what you're seeing now is the treasury market is beginning to get indigestion in anticipation of this coupon issuance. So yields are continuing to back up. Now, what people can't quite understand is if you've got a Federal Reserve that is talking about policy rates, in other words, Fed funds rate being near their peak levels. I mean, this is the latest rhetoric that's coming out of Fed governors. They're saying maybe we're at the peak of rates, whatever. Obviously, it's the old story of some say yes, some say no, but the whole tenor is to say we're somewhere near the peak. Why is it that the bond market is basically selling off and yields are going up? And the reason is it comes back to another component of bonds, which I promise you is a wonkish concept, that is called the term premium. Now, the term premium, if I can explain that as succinctly and as simply as I can, it's like a risk premium on the treasury market that is calculated as the difference between the actual yield, let's say, on a 10-year bond, and what you would have to pay if you rolled a short-term instrument every year for 10 years. So in other words, it's the difference between expected policy rates, what everybody expects the Fed to do in the next 10 years on average, and the 10-year yield. That spread is what's called the term premium or the risk premium on the bond. Now, that's normally positive, right? It's normally 25 bips or there or thereabouts. That's what the risk premium is. What is it right now? It's about minus 150 basis points in our calculations. So it's really, really negative. And why is that? The reason being is that globally, there is a shortage of so-called safe assets. Now, what does that really mean? Let's explain. The US has enjoyed a perfect storm in the last decade because there have been huge inflows into US capital markets, unusually large inflows. It's not just China and Japan buying, but every country worldwide has been buying US securities because in the wake of the global financial crisis, the regulators said that the banks and insurance companies had to have more safe assets. And the safe asset of choice is really the US Treasury bond. Okay. Well, in fact, strictly the US Treasury note, which is either a 5-year or a 10-year maturity bond. And those instruments were in great, great demand. And the Treasury wasn't really issuing very many of them. So they were basically in excess demand. And anything that's in excess demand, the price goes up and the yield comes down. And so what you were getting is yield compression at the long end of the Treasury market. And basically that meant a negative term premium. So actually, if you look at the term structure of US interest rates, you've got short-term rates that are what, sort of circa 5.25%, 5.5%. And you've got longer-term rates that are right down at about just over 4%. Now, that spread is something like about, well, technically it's minus 150 basis points. And that's explained by this negative term premium. And that's because of an excess demand for coupon debt. If you're right, which you are, and coupon issuance is going to increase significantly, and the Chinese are not going to buy debt anymore, that term premium is going to start to go from big negative to smaller negative to maybe positive. So you could be getting an uplift on the US Treasury 10-year note of 150 basis points from here. In other words, start to expect about 5.5%, possibly 6% yields on the 10-year Treasury note. That's the worrying thing. Yeah. Will the Federal Reserve want to oversee that? I think they would be reluctant to do that. And I think they'll be doing everything they can to try and keep yields down.
Yield curve control is that, I think, is that exactly what we need to discuss here.
I'm a cynic, but I think yield curve control is currently in play because I think that all the attempts to target money funds with Treasury bill issues directly, which is they've marketed directly to the money funds in a way they haven't done before. They're draining the reverse repo program deliberately. The index of bond volatility in the markets, called the MOVE Index, has collapsed in the last few weeks. It peaked at 200 on the index in March at the time of the SVB crisis. It's now under 100. What does that mean? If you translate that very crudely, a 200 index is a 20% volatility in the bond market, which for bond for people in the bond markets, that's huge. I mean, that's extreme volatility. You'd expect that in equities, but not in fixed income. And we're now down to just below 10%. But the normal average is about 7% or about 70 on that index. So, what you've got to expect probably if the Treasury are doing what we think they're doing is they're trying to manipulate the term structure or the yield curve by pushing volatility down. They're also talking about doing Treasury buybacks next year, which means effectively improving liquidity in the Treasury market by buying stale issues and reissuing new bonds, which increase the liquidity of the market. Now, it's not beyond impossible to say that they could also alter the average duration or maturity of the Treasury stock when they do that, which would be another way of influencing liquidity and yield structure.
Michael, we got to put a bow around this now. Unfortunately, it's been hugely insightful. I'm going to call this episode a masterclass in bonds and liquidity. Absolutely, super interesting. Trying to get a summary of what you've sort of mentioned. I was like, it was really comprehensive, but maybe turn that into a bit of some actionable advice as well. Like you're saying, you're expecting a spike in bond yields, like that pretty much means a crash in the bond market.
Well, I think that let me put it.
Just
in these
trying
terms.
to be more clickbaity a little bit. So
I wouldn't be buying bonds.
Yeah.
I think there are upside risks in yields in the bond markets. I think the authorities will do everything they can to stop that. And what we've seen historically is that when the authorities do things to stop that, they basically print more liquidity. So more liquidity is coming. And the bottom line in this whole thing is that the new equilibrium in financial markets to think about is there has to be a balance between debt and liquidity. If you believe that debt is going up the whole time, which it is, you've got to have rising liquidity. And rising liquidity is fungible in the sense that it spills over to other asset classes. And so what you've got to see is if you're in an environment of a monetary inflation, then you've got to basically buy monetary inflation hedges. And that means more equities, less bond duration, in other words, less coupon bonds, and you've got to be thinking about gold, commodities, cryptocurrencies, equities, maybe even real estate or residential real estate, let's be clear about that, and not having such a big allocation to coupon bonds. And that's what I would do. By all means, put money in short-term debt. That looks pretty sensible, given the yields. It's risk-free at over 5%. Looks pretty good to me. But you've got to start thinking about portfolio structure in a way that people haven't thought about before. Bear in mind, the last 20, 25 years have been a period where bond returns have been eye-wateringly great because yields have fallen from very high levels, okay? And now yields are pushing up. But, the problem is that when yields go up, bond returns go down.
Absolutely. Michael, super insightful. Where can we find more of you? You run a fantastic Substack as well, I think.
Yeah, we've got a Substack which is called Capital Wars. That's named after a book I wrote about 3 or 4 years ago with that same title, Capital Wars. That describes all about global liquidity. We've got a Twitter handle which is at CrossBorder Cap, and we've got a website which is crossbordercapital.com. So many different angles.
Absolutely fantastic. I need to follow up with you. We need to do this again. There's so many avenues we haven't really explored yet. Just in the interest of time, we could have turned this into a 3-hour discussion. Do you offer master classes at all, or short courses and things like that? It was hugely insightful.
I must say, I haven't done that yet, but maybe you've given me a thought. Maybe that's what we ought to be doing.
Absolutely, you should be doing it. Absolutely. I was just sitting here. I was just like, I'm not going to interrupt you. I'm just actually enjoying this because I learned a lot. So for me, it was hugely insightful, and I hope for everybody else it was hugely insightful as well. Thank you so much for joining us. Thank you for subscribing to the channel, because your subscription helps us bring guests like Michael on the channel. Tremendous insights here into the global liquidity markets. I think we don't talk about the global liquidity markets enough, in my opinion, because if you throw geopolitics into this as well, it's hugely important. So Michael has written a book about it, but I think there should be a lot more books personally written about it as well. You can make actually Netflix movies and TV shows out of this, in my opinion, because it's a fascinating topic. I'm getting ahead of myself here a little bit. Subscribe to the channel. I know 80 to 85% of you are not subscribed. Engage with us. What are you thinking is happening? It helps us bring more guests on the channel, and we really appreciate it. Thank you so much for tuning in. We'll be back with more.